Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon. Ira Epstein of Linder Associates with your agriculture update for this Tuesday, the 25th of April, 2017, about 1:50 p.m. Central Daylight Time. Unbelievable day. We walk in today, and today's what we call Turnaround Tuesday. Will the markets reverse the actions they had on a strong Monday? Now, strong could be an upside or a downside, just big moves. And the answer is no, it did not. Stock market, some of the indices going up like in the NASDAQ for record highs at this point. The Dow up dramatically higher, and yes, it's off about 20 points from its high, but it's still up 250 points on the day, and the S&P higher. It's the combination in financial markets which are impacting grains to a degree, and we'll talk about that for just a moment here. The French election, the idea that France will at least has a really good shot of staying within the European Union, and that won't break that down. Tax talks. President Trump backing off today on the border wall talk that it has to be tied for the debt ceiling, another big positive. Cutting of income tax ideas, be it for individuals and or corporations. Big deal. And of course, if you saw the earnings on McDonald's, Lilly, I can go on and on. Big numbers, big beats, and that helped. Now, in the grain market, one of the things that I know we have been telling our clientele is you have strong rains coming into the Midwest. Those rains will be in parts of it for up to 2 weeks. We start tomorrow in big parts, though, that last from tomorrow through Sunday, a small break, and then again, they're forecast 10 days out. That's driving up the corn prices and the wheat. In the soybean market, not so much, and think about it. Soybeans, you've only got about, maybe 5% of the crop planted. Corn, at least you got about 20%. And it's still April, friends. You've got plenty of time to get these crops in. So even if a farmer has to do some replanting, okay. But because prices were so cheap and because there's often you get that spring low in the grain markets, you're getting a bounce there. Meats got strong today as well. We saw strength coming back into the cotton. Pretty narrow day in the sugar, but we'll get to the softs in a minute here. Remember, the dollar's down another 30 points today as the euro's up, and that helps the idea, at least, that our exports become a tad more competitive. As we're looking at the market, you've gone from 1080 down to 929 3/4, and here you are up on the week for about 3.5 cents. So not a lot of volatility for the week so far, and I think you can see that. When you go to an area chart of closes, well, we're down 6 3/4 from the 970 1/4 close that we had yesterday, but you still have a pattern where you're generally making those higher highs all the way through. As we take a look at the chart of, and this is called a bar chart of the market, each bar represents a day. You can see how the market has been coming up here to the 972 level and stalling out. You can visually almost see a trend line coming through those lows. I would say you don't want to get under the 960 level on a close if you don't want to break out to the downside. We had a triangle formation that I showed yesterday. We broke through that. Today you're giving up a little bit, but that lower line is going to be your support line. As you come in and you look at how the swing line is going, 954.5 would be the damage number. Why? Right now you have a pattern of higher lows, and I've marked them with the dark arrows, and you certainly see the higher highs. That is the definition of an uptrend. A downtrend would have lower highs and lower lows, plural in both sense. So you've got it there. When we put on the 18-day average of closes, that ties in pretty nicely to that uptrend line I was talking about, and you can see where about that would come in. So we've still got an area here that as long as 54.5 isn't taken out, the market has a cushion to break. It could break as much as 7 cents back to that 18-day average of closes for support. The resistance is pretty clear here at the lower Bollinger Band, and it's going to drop down again tonight. It's not going to go up. It's going to come down. If you understand the math of it, it's what will happen. And we'll slip down just a little bit one more time here. And notice how the band is starting to narrow in right through there. So this big decline that we had is now met with price that is losing, number one, downslope, number two, volatility, and it starts narrowing in as the market's going. It's not a one-sided direction. If you believe that momentum leads price, the slow stochastics, which are made up of two lines called a K and a D line, they are still pointing to the upside, but they have reached on the daily charts an overbought area. Hence, we're starting to see a bit of a stall in the marketplace. In the meal market, I want you to look at the upper Bollinger Band. The market went literally right to it. It went through it by one tick, swung back the other way. But do we trend here? That's the problem. We're not. We have a pattern of a lower low. Do you see this low here and that one? But then we come up and we make a high that took out a previous high. You have nothing. You have a market that's trying to figure out what to do next. And you see here, better than you do in soybeans, that sideways action forming. See how now the black lines are going sideways, those Bollinger Bands? That's important. Momentum, still to the upside, and unlike the beans, not overbought. In the soybean oil market, you got to the upper Bollinger Band, fell back for support yesterday and again today, right at that 18-day average of closes. Therefore, what do we have? We have an uptrend. The market has got higher lows, higher highs. It is staying at or above the 18-day average, so the bias is up, the swing line is up. The momentum has stalled. It's pointing down, if anything, and you've broken back and you're back into that sideways action. It's almost a wait-and-see period going on there. In the corn market, you went right back to the 100-day average of closes. See the green line? That's your resistance point. So what we've really done, we went from a swing line high all of 1, 2, 3, 4, 5, 6 days later, the swing line low, swing up, right through 2 days later to the 18 and the 100-day average, and that's where you're at. What the market might be saying, and this is important to take into your trading, is this going to prove to be a spring low? We know part of the reason why the market is up could be the lower dollar. Part of the reason the market could be up is because of the rains coming in, delays in planting, and the like. But I have been around this game now 40 some odd years. Every year we talk that we're going to have too much or too little rain. Every year we're going to have weather that kills the crop. Every now and then it happens, but most of the time it doesn't. So keep that in the back of your trading. Seasonals generally are up at this time of the year. In the wheat market, double bottom area at 416. Now today's low was lower than yesterday's by a quarter cent. So you do have the lower low, the higher high. But what did I say yesterday if you listen to the tape? 3 days in a row under the lower Bollinger Band only gives you, from my rule of thumb, a 2% probability of the market not getting back to the right-hand side of the Bollinger Band. And that helps, I think, in trading because you're understanding the odds of it staying under that band very, very low, 98% not. And that is the theory of Bollinger Bands. 95% of the time you will stay within the bands. Yes, you can get out of them. And if you do your counts like I do, I have seen, the most I've ever seen is about 9 in a row. 7 is stretched out. I throw the 9 out because it's an unusual event. 5 is really pushing it. So if it's 5% of the time it stays out of the bands, let's rule of thumb until it steps out to 6 days, say that each one of those days counts as a percentage point. That's my theory, mine alone. But I find that it really helps when looking at that market the way that I teach trading. In the sugar market, notice how the market's paying attention to the lower Bollinger Band that is oversold. It's a hard market to get short. Why? If you get short the market, which it is in a downtrend, lower highs and lower lows under the 18-day average, first thing is you're oversold. Second thing is, if you believe in the Bollinger Band theory, what are you looking to get into the 20 area? It's just not a lot of play for your money. Coffee's different. Coffee's riding the lower Bollinger Band. Now, let me show this because it's so important. This is sideways action. Here is the market breaking out, and we've got a pattern now of a higher high and a lower low, but you're under the Bollinger Band. You ask yourself in that question, Is the market strong enough on the downside to bend the band and keep it bending? If so, it's going to widen out like that. Watch what happens. Goes down the next day. This was Friday. This was yesterday. This is today. So we've bent that band out. Now, to negate the downtrend, you take out yesterday's high in the 134 area. Bingo. That would give you then a lower low and a higher high. Today's low was 130.50, the day before 131.55. So what number as a bear would you not want to see? You don't want to see yesterday's high taken out. Barring that, you are oversold, but the trend is still down. In the cocoa market, the market is suddenly trying to hold here, and it's no longer embedded. What is embedded? It's when the slow stochastic doesn't have both numbers under 20 after it's done so for a minimum of 3 days in a row. And here you had them under 20. You can see how prices were falling as that was occurring. When it occurs, you could start saying to yourself, okay, if the market's going to follow through, where might it go? And I say, might go back to wherever that 18-day average is on the chart. In the cotton market, it is a market that wants to and acts like it wants to stay over the 18-day average of closes, which keeps a bullish bias to it. What else? It is an overbought market and is void of trend. If you define trend like with the swing line, in this case you got a higher high and a lower low. So upside bias, overbought, that's how I'd talk about it. Cattle market still lost its embedded reading. When you have a loss of an embedded reading, and you had it yesterday as well, 2 days in a row, you cannot gain it back tomorrow. Prices often, the word is not always, often make a run at price in the 18-day average coming together. And if they're going to do it in a good way, means making the rule work right away, it happens very quickly. If it's prolonged, that average will come up to the price. So right now, the market still has an upside bias because it's over the 18-day average, but it is weakened internally, as have the August feeder cattle. Now, today we had a heck of a rally hitting the hogs. It did not change the trend. It lost the embedded reading. Let me show you how this works. You had the embedded reading. If you lose it, price and the 18-day average often, but not always, make a run at each other. That doesn't mean that those that are bearish are wrong. You'd have to take out 72.90. But now what the bears have is a market that is oversold until you get both numbers over 30. You're not there at this point, so how much heat do you want to take in the kitchen is a way to look at it. You put it all together, that's how I look at the marketplace. Now let's talk about a guide to technical indicators. This guide was put together by our good friends at Modern Trader magazine. And it talks about all these different types of indicators. If you want to learn, here's how they do it. It's about a 23-page booklet done in full color. And we send it out to you as a PDF. Via this, you start getting an idea of the relationships of one of these indicators to price, how different traders look at them. Is it going to make you an expert in them? Absolutely not. Is it going to give you a real good idea as to how they operate? Absolutely. How do you get it? Give us a call. Go to our website at www.iraepstein.com or click right up here. Some of you will also see us on other websites. When you do, under us, it'll say click here for that. Click that link. It'll carry you right to where we're at, and away you go. I'm Ira Epstein. Thanks for watching, and I'll see you all tomorrow.